Hello everyone and welcome. In this video we are going to be taking a close look at small cap stock, T Clarke PLC, and whether or not this could be a bargain share worth adding to your portfolio. Small cap stocks can offer value to private investors not found in larger companies, by virtue of the fact that there is little coverage of these stocks, and therefore arbitrage opportunities are more likely to arise. With that in mind, let's get started. T Clarke PLC is a building services contractor, based in the UK, and headquartered in London. The company is well established, having been founded in 1889, and provides services in a range of sectors. The company attempts to differentiate itself by supplying a high-quality service, and the fact that the company is so long-standing should provide some confidence to investors with respect to their credibility. The revenue earned by the company can be split into the following segments. We can see that M&E consulting makes up the largest share of revenue, but there is a good degree of variety in revenue generated. As a result, the company is not overly exposed to any particular sector. We can also see that the company operations are highly concentrated in the London and southern region of the UK. This means that the outlook for the company will be highly dependent on conditions in these areas in particular. The figures on this slide show the performance of the company in the financial years from 2015 to 2019. In particular, we can see that revenue has grown consistently in the period, up to £334 million in 2019, from £242 million in 2015. This represents average revenue growth of 8.3% per annum. Moreover, net profit earned by the company has increased significantly over this period, and dividend yield has also been consistent at around 3 to 5%. In terms of pricing, there has been significant fluctuation in price over the 5-year period, which you would expect for a small cap stock. Overall, there is a positive trend, however, and the price-to-earnings ratio has remained in single digits for most of the period. In 2019 the company earned an after-tax profit of £7.8 million, and as at the 31st of December, the market capitalisation of the company was around £55 million. So, going into 2020, the performance of the business appeared to be strong. However, in March 2020, the COVID-19 pandemic began. This caused some significant disruption to the business, with multiple sites closing due to restrictions in place. As a result, the share price fell dramatically from nearly 140 pence to around 80 pence. As of June 2020, the company reported an underlying pre-tax profit of £1.5 million, generated primarily in Q1, and a statutory loss of £1.5 million after deducting restructuring costs of £3 million. Management stated in the half-year report that the restructuring actions taken are expected to save £4 million annually. It is notable that, despite the significant disruption in place, the order book, which consists of all future projects where the company has a commitment to proceed, actually increased to £402 million of revenue from £370 million at the same time a year earlier. As a result, the disruption does not appear to have severely damaged the future ability of the company to earn revenue. We also note that, in an update given in November 2020, management stated that they expect to deliver a 3% operating profit in H2 2020, which is in line with 2019 and Q1 2020. Considering the company has shown resilience, there may be an opportunity in the fact that the share price remains 30% below its pre-COVID-19 level. The share price was at 94.88 pence on the 24th of December 2020. As stated previously, the company expects to deliver an operating profit of 3% in H2 2020, despite challenging conditions surrounding COVID-19. Even so, balance sheet resilience is important so that we understand how well the company may be able to endure future downturns. As of June 2020, the company held cash of £22.5 million, up from £12.4 million at December 2019. This is in addition to the fact that the company has recently renewed a £25 million revolving credit facility with its bank until 2024. The company had drawn down £15 million of this facility, leaving £10 million further which it could draw down on if necessary. Excluding the bank loan liability, the company had net current assets of £22.4 million as at June 2020. This has increased from £12.8 million in December 2019. This should provide further comfort that the company has sufficient liquidity to carry on its operations. Overall, there has not been much turnover in the management team in recent years, which is a good indicator of stability internally within the business. Notably, the Group Chief Executive, Mark Lawrence, has been with the company for over 30 years, and the Group Managing Director, Mike Crowder, has been a director since 2007. The Chief Financial Officer, Trevor Mitchell, was appointed in early 2018, and has overseen the last 2 years' positive financial results, including improved cost efficiency which is shown through improved margins. Moreover, the Chair of the Board, Ian McCusker, has been on the board since 2009. In estimating the equity value, we have made some simplifying assumptions and further judgments. The point of this valuation exercise is to provide a general idea of what the market is assuming in the current share price, rather than to give an opinion of valuation. In particular, we have assumed that free cash flow to equity is approximately equal to earnings, and we have also assumed that calculating equity value directly by discounting future earnings, using the cost of equity, is a reasonable approach to take. As shown, we have forecast earnings for 2020 at £1.23 million, which is based on management's guidance on revenue and operating margin. However, this bears little relevance to the final valuation, as 2020 is almost at its end. We have forecast that revenue will not recover to pre-COVID levels until 2022 and, with current uncertainty in mind, we have not forecast beyond this point. We have then calculated a perpetuity value using an assumed growth rate of 2%, in line with UK inflation targets. Some may argue that these forecast assumptions are relatively prudent, but the fact that the construction industry is cyclical should also be considered. We'll let you be the judge. In terms of discount rate, we have used a range from 10% to 15% to illustrate how valuation changes depending on the rate used. These discount rates are relatively high as compared to the cost of equity calculated below, of 7.96%, however the fact that this is a small cap company may mean an additional risk premium is required. Based on the assumptions applied, the company appears undervalued, but there is significant variation depending on discount rate applied. To reiterate, this exercise is to show roughly what assumptions are driving the current share price, so that you may come to a judgment, rather than being a precise valuation. Overall, we have seen that T Clarke PLC has shown resilience in its trading in light of disruption around COVID-19, as shown by management expectations of 3% operating margin in H2 2020. We have also seen that the company has continued to show its ability to tender for and win contracts, with its order book actually increasing since 2019. And we have also seen that the company to date has maintained a strong balance sheet position. The share price has not recovered from pre-COVID levels despite this, and it may be that the company is undervalued. In terms of key risks for the company, the construction industry is cyclical in nature and revenue earned by the company is likely to be exposed to this. The success of the company will depend on its ability to continue to attract new contracts. There is a concentration of revenue earned in London and the South East, and there is a risk that the operating conditions may decline in these areas. Further risks around COVID-19 remain in the short term. So, what do you think about T Clarke PLC? Tell us in the comments below. That's all for today everyone, thanks for watching. This video was brought to you by the Personal Finance Institute, where our mission is to bring financial literacy to you, so that you can plan your financial future. If you are finding our content useful, informative, and you'd like to see more, please do like, share, and subscribe. If you have any questions or if there are any topics or stocks that you'd like us to cover, please let us know in the comments below.